Stop letting fear hold you back from investing more. If you're not careful, putting off investing will turn into weeks, months, and even years that you could have spent building your wealth. However, risk is a critical topic, especially for beginners. Hearing terms like risk appetite, risk tolerance, risk capacity, these can be overwhelming. Let's start with an explanation of these and other terms to get you started today. Risk appetite and risk tolerance are somewhat similar, but not necessarily interchangeable. Risk appetite generally refers to the level of risk that you are ready to take on in that moment. For a beginning investor, your risk appetite will depend on your existing assets, goals, and your age. Risk tolerance usually means the acceptable deviation from your investment philosophy. A helpful illustration is the difference of speed limits. The government organization sets a speed limit for a particular road based on safety, traffic flows, environmental issues, and many more. That limit reflects the speed appetite of that corridor or street. Often the law enforcement agency won't issue a violation notice to drivers exceeding the speed limit by, let's say, a small percentage. That leeway is what you could call the speed tolerance. Finally, risk capacity refers to your realistic ability to lose money in any investment. You may want to be a really aggressive investor, but no one should risk losing money that they need to live on a day-to-day basis. Now, if you want to be aggressive and you have higher assets, you have a greater risk capacity naturally. So how much risk do you need to take? Well, the truth is, every investment has risks, but some have a lot higher risk. Often the investment with a higher risk offers a potential for much greater returns, although this is not always the case. The danger is that you lose money when your goal is to earn money, which your goal should always be to earn money. For example, if you buy shares of a stock at, say, $10 a share, you do so in the hope and maybe the expectation that those shares are going to increase in value over time. It's possible that you may also anticipate that the company will pay a dividend. And then you can decide on whether to reinvest that money or to use the dividend as cash flow to yourself in that moment. The risk is that stock shares will be worth less when you try to sell them. This is effectively losing in the stock market. The risk level is the possibility of losses versus gains that you have on any of those trades, again, using equities as an example. If you have an aggressive risk appetite, you will likely invest in individual equities and bet on your ability to analyze their financials and their future outlook and determine what's best for yourself. In contrast, a more conservative investor will likely diversify their portfolio between stocks, bonds, or maybe some mutual funds or ETFs, and most importantly, real estate, because it's the freaking best. Bonds essentially are debt instruments issued by either governments or big corporations that typically have a higher likelihood that you're going to get your money back. In either case, the return you as an investor receives is fixed, which is why bonds are often called fixed income investments. As a result of this, again, you typically do incur less risk with bonds, but you also have a lower potential for returns than you would see in something like a real estate investment. The beauty of mutual funds in this context is that fund managers do all the work of balancing the investments. For example, if your index fund owns every stock in the S&P 500, like maybe a VU or maybe a SPY, the risk of losing money is less because if one or two companies lose some value, you don't really feel that impact because you have another 498 companies that balance out those losses. But on the flip side, you're not going to gain as much from individual companies having meteoric rises because the rest of the stocks are going to drag that return down. Most importantly when looking at these examples is that the simplicity allows for returns to be stable over time. Renowned investor Warren Buffett believes that most people are actually better off investing into index funds than trying to choose individual stocks on their own. Similarly, for my own portfolio, I really like the balance of real estate and ETFs for myself. The ETFs give me access to all major markets that I want to be a part of. For me, that's typically the S&P 500, the Dow Jones Industrial, NASDAQ, and then the Russell. Between ETFs that cover those four, I consistently analyze my portfolio and see that I'm well diversified across all indexes that I want to be involved in. And that, mixed with my huge portfolio focus on real estate, creates a much more balanced approach. And by the way, like we've talked about in many other videos, there are great strategies for doing both, like borrowing against some assets and investing in others, and vice versa. So with us living in an age where huge advancements in AI are coming out, what about investment apps and robo-advisors? Investment apps and robo-advisors are automated ways to get guidance without spending a ton of money hiring an investment manager human. In either case, you complete a profile that includes your investment goals, your timeline, your risk appetite, and the available assets that you currently have. From there, the advisor, or the artificial intelligence, selects and obtains the best investments for you based on the information you provided. Typically, the cost is much less for robo-advisors than dealing with a human, but it's still typically more than executing the trade on your own and making your own decisions. So what's the right balance for a beginner's portfolio? That's a smart question at this stage. Remember, your investment strategy depends mainly on your personal risk appetite. If you want to increase your holdings significantly and quickly, and you aren't afraid to lose money, you can invest much more aggressively. On the other hand, if you don't have a cushion and you're not willing to maybe lose a few bucks along the way, you're going to want to invest more conservatively. In this case, most often you're going to hear the advice of a 60-40 portfolio. This is 60% in growth items like real estate and stocks, and 40% in fixed income investments like bonds and income funds and things that will pay you out exactly the same amount that you can rely on. The 60% in the growth categories, like real estate and stocks, has a much greater chance in increasing, but can also lose value if it's the wrong investment. And that's where the 40% of fixed income comes in, whether it's bonds or income funds. It balances out the ups and downs of the growth side with some consistency for your portfolio. Now, if you wanted to go more aggressive, you could adjust those from 60-40 to 80-20 growth to fixed income. Or if you wanted to go more conservative, let's say you are older or closer to retirement, or you really never wanted to take a risk on any of your money, you could adjust that to a 50-50 or even greater in the fixed income category and less in the growth categories. Now, as always, let's jump into some interesting data for you to analyze. From 1926 to year 2020, the typical 80-20 portfolio returned an average of 9.61%. Over the same period, a 60-40 balanced portfolio would return an average of 9%. A portfolio invested fully into stocks, meaning zero for bonds or other fixed income instruments, that portfolio returned over 10.2% in the time frame. Still, that 100% stock invested fund also lost over 43% in its worst year. That's an example of the wisdom behind the 60-40 portfolio balance. But let's not forget about real estate, huh? As a beginning investor, you may not yet have the assets to buy, let's say, large commercial buildings or even a single rental property. However, that doesn't mean you can't enjoy the potential benefits of real estate investments. Consider real estate investment funds. They allow you to own fractional portions of high-quality commercial properties selected, obtained, and managed by a professional real estate sponsor. These funds offer the convenience of equity investing with the potential of real estate appreciation. And guess what? Without the hassle of being the actual landlord and dealing with tenants and toilets. And while the stock market from 1926 to 2020 earned an average of 10.2% over that period of time, the reality is real estate in most markets knocked it out of the park much more than that. It is not uncommon today to see real estate opportunities that average anywhere from 12 to maybe even 16, 18, maybe 20% returns to investors. So it actually outpaces the stock market in most examples. We had an amazing discussion on this topic and what the absolute best way was to invest your first $5,000 into today's market. I'm going to put up a link next to me now for the video and how you can check out that discussion where we dive in depth on how you can invest your first $5,000 or the best way to invest $5,000 that you have on hand today. In the video, we go through a step-by-step process of where you can put your $5,000 and why each strategy works in the complicated world and investment markets that we are living in today. $5,000 cash in your hand right now, baby. What if that happened? Do you know how to turn $5,000 into massive upside and improve parts of your life massively?